All right, we've given folks a couple minutes here. So for everyone else trickling in, that they'll do just that. They'll be trickling in. So hello, everyone, and welcome to the third installment of our three-part webinar series on catastrophe risk management. This is being sponsored by the Meteorology Alumni of Penn State's Weather Risk Alumni Society, and this is done in partnership with the International Society of Catastrophe Managers, ISCM. My name is Brian Bastian, and I'm the president and founder of the Weather Risk Alumni Society. Today, I'll be moderating the question and answer session for our two guest speakers, alongside my fellow industry colleague, Sherry Zola of Munich Re. So we do encourage questions. If you have any during the presentation, we encourage you to submit those via the Q&A feature of the Zoom application. Sherry and we will be monitoring those questions, and we'll make sure to best answer those at the end of the presentation. So without further ado, I would like to introduce our speakers first. So first off is Wendy Hayes. She's Vice President and Head of Catastrophe Risk Analytics at Cincinnati Re. Wendy leads the Catastrophe Modeling Center of Excellence at the Cincinnati Insurance Company in its reinsurance unit, Cincinnati Re. She works to provide critical analytics that support catastrophe-related underwriting, pricing, and accumulation management functions across the organization. Wendy has 20 years of experience in catastrophe modeling and holds Bachelor's of Science degrees in mathematics and statistics from the University of Minnesota. So welcome, Wendy. And our second speaker is Julie Serakos, Executive Vice President and Catastrophe Analytics Head at BMS Re US. Julie oversees a team of analysts who work closely with insurance carrier clients to manage their catastrophe risk through the use of catastrophe models. Julie has nearly 30 years of experience in the industry with engagements consulting with risk management solutions on the development of its hurricane, severe convective storm, and workers' compensation models, as well as advising the Florida Commission on Loss Projection Methodology on the framework for reviewing the science of catastrophe models. Julie holds a Bachelor's of Mathematics degree from the Institute of Technology at the University of Minnesota. So with introductions out of the way, Julie, I'll let you take it away.
All right, thank you, Brian. Now, in this session, Wendy and I will be providing you with an overview of how CAT models are used to manage risk. And to provide more context to how the models are used, we're first going to be talking about the various insurance industry players to give you an overview of some of the key roles within the industry and how each of these entities works together and how they use CAT models to inform their understanding of CAT risk. So the primary learning objectives of today's session are, first, to become familiar with the various entities in the industry and how they relate to each other, to be able to describe how CAT models are used in underwriting and risk selection, to understand how the CAT models are used to design the various reinsurance or insurance products, to explain how CAT models are used to optimize a portfolio of exposures, and lastly, to define how CAT models are used during a real event. Now, throughout our discussion today, Wendy and I assume that participants have attended or watched the other sessions and are familiar with some of the general concepts of CAT models and key insurance terms and the like. So we won't be going into detailed definitions of those concepts, and just assume that everybody is fairly well understands some of those key concepts.
All right, this is Wendy. For everyone getting used to voices on the phone, let me get started here. So again, just a quick overview on the key parties in the insurance industry. There are really three key parties, just to boil it down. There is typically a party that wants to transfer risk, a party that wants to assume that risk, and then a party that facilitates that exchange. So the portion of the insurance industry that probably everyone on the phone is most familiar with would be, you as a policyholder. You might own a home, you might own a car. So you have some risk associated with that. And so you want to protect your investment, so you will reach out to an insurance agent who's going to help you transfer that risk to an insurance company. That could be an independent insurance agent, it could be an agent affiliated with a large insurance company. But that insurance company is willing to take that risk on should something happen to that exposure. Then sort of behind the scenes, which most people are not as familiar with, is that insurance company is taking on thousands and thousands of, if not millions of risks from policyholders. And then they may start to be concerned about aggregation of risk, accumulation of risk, and their exposure to particular catastrophic events. So they will also look to transfer their risk, again, on this much larger scale, and they will work with a reinsurance broker to help facilitate the transfer of that risk to a reinsurance company. So as we move through the presentation, the way that the presentation today has been structured is that Julie will speak to the point of view of both the insurance company and the reinsurance broker who is transferring that risk. And then I will jump in and speak to the point of view of that of a reinsurer.
Okay, now this is Julie again. Now the premise of risk management includes four main forms: avoiding the risk, reducing the risk, retaining the risk, or transferring the risk. And as we adopt one or many of these forms, we consider these options as we are trying to manage the catastrophe risk. So for those of you that have sat through session one, Brian and Kim provided an overview of the general process that is taken as we look at the overall risk on a portfolio. So the first step is to really identify the loss exposure in the portfolio, to understand it, to analyze it, and really understand the size of loss potential, the frequency of that loss potential. And then we move into a process where we're examining these risk management options. So should we choose to avoid the risk altogether? Let's not even write it, and let's not even have it become part of our portfolio. An option would be to reduce the risk. If we feel we've got too much of it, let's find ways to remove some of it from the portfolio. We may choose to retain some risk, and additionally, we may choose to transfer some of the risk off to third parties. And so we continually review these options and select one or many combinations of these options, and then move to a point where we're implementing these options and then monitoring the results of the portfolio. And at regular intervals, we will check in to make sure that the overall process is behaving, the risk is in line with what our goals and objectives are. And if it falls out of line with that, we may choose to implement some additional tools and procedures to affect the management of that risk overall. So in the context of our discussion today, we will be describing many of these types of risk management options as respects how CAT models are used to help fulfill those objectives.
All right, so the outline or the agenda for today, Julie's touched on a couple of these things, but we'll start with underwriting decision support. So how can CAT models be used to determine if a risk is something that we want to take on? How do we use CAT models to determine if the price or premium is adequate? We'll cover accumulation management. So how do we use models to avoid concentration of risk? We'll go into a little bit more detail on that risk transfer subject. So how do we determine what is the right reinsurance structure? How do we use CAT models to determine that? We'll also talk about strategic growth and optimization and how we can use models in those applications. How can a company, where and how can a company grow? And then also we'll touch upon real-time event analytics. So this has been a very busy catastrophe season, a busy hurricane, wildfire season. So when we talk about real-time events, how can we use CAT models to help insurance companies and reinsurers in those situations? So I'm going to pass it over to Julie.
Okay, thank you. So underwriting is the process of reviewing the risk. So the risk being the property to be insured. So making sure that it meets some predefined criteria set out by the insurance company. Does it fit the type of risk the party is willing to take? And it also includes an analysis of the premium needed to cover the risk. So from a primary insurer company standpoint, CAT models are used to inform on the relative hazard of this risk. So, for example, for hurricane exposure, for any risks or properties that are located within coastal areas in coastal states, CAT models help inform the level of risk through the level of hurricane force winds that a location might be subject to by way of the distance to the coast. And so CAT models help inform that understanding of that relative hazard. Likewise, hurricanes produce significant storm surge. And so the distance to coast will help inform the relative vulnerability that a property might have to storm surge loss. And so there may be guidelines in place that limit the amount of properties that are to be written within a certain distance of the coastline to limit that hurricane wind exposure as well as that storm surge exposure. And some of these are illustrated in the graphics on the slide. You can see the pinpoints in the map representing the risk or the property insured, and guidelines overlaid that help underwriters determine different levels of coverage to be offered for those locations. Similarly, for earthquake risk, the underwriter may look at the distance to the nearest known fault that a property is located in, as well as considering any landslide risk or liquefaction risk as another example of the type of hazard that would be considered during that underwriting process. So furthermore, on the next slide, CAT models help determine the price that would be charged for this coverage. And so there are four main components of the premium, or what is charged for the insurance policy. And this is illustrated in the graphic on the slide. So the loss cost, which is reflected here by the CAT loss and the non-CAT loss cost, is the amount of the cost to cover the expected loss on that property. And for the CAT loss component, this is where CAT models are used to inform the expected long-run average cost of covering catastrophic risk on this particular property that's to be insured. It can also be viewed as the minimum amount of premium to cover the catastrophe loss exposure for that particular risk. Non-CAT loss includes other losses from, say, fire or theft or just general damage to the property itself. So those two combined form the loss cost component part of the premium. The risk load is a measure for that volatility around that expected loss cost. So there's an amount included for that relative uncertainty around that loss cost and the potential volatility of those losses. General operating expenses are shared across all of the policies that are written, and that's done by way of the expense load. And then lastly, there is an amount for the profit load. So these really form the primary components of the premium, and for the CAT models are used to inform that catastrophe loss portion of the premium. And certainly locations or properties that are in more highly catastrophic exposed areas, that CAT loss component is going to be a larger component of the overall premium.
Okay, so turning from this to, the reinsurer's point of view, just as a reminder, Julie spoke to an insurance company that's looking to price out a single policy, let's say it could be a single home, it could be a single, college campus, that sort of thing. From a reinsurer's perspective, what we're doing is we're looking at, again, thousands of policies and even millions of policies that belong to an insurance company. So we're looking at that on kind of a higher scale, right? A more aggregated scale. But when we talk about this, really the concepts are exactly the same. So the slide is exactly the same, really, as what Julie just showed. As a reinsurer, we still need to use the models to understand the CAT loss component We still have expense load, risk load, profit load. All of the concepts are exactly the same. So just to kind of blow this out in a little bit more detail, from a reinsurer's perspective, again, we start with catastrophe modeling output. We apply loads. Julie spoke to risk load as an example. We may also load for non-modeled exposures, exposures that are covered under a reinsurance contract, but we don't have a model for them. We also look at assessments from different residual markets, which are in essence sort of governmental, state governments assessing in large events to insurance companies. We might load for growth. If an insurance company is going to grow over the course of a reinsurance contract that it's in force, we would load for that. We will apply the reinsurance structure itself. So again, reinsurance, what we're talking about in this context are catastrophe reinsurance contracts. They cover catastrophic events, and they pay out in typically a large loss event scenario for a company. So we're looking at reinsurance structures that attach typically at a very high loss level. So we have to apply that structure against the catastrophe modeling output to understand as a reinsurer what our loss potential would be. We account for the financial terms of the contract. So we have to pay brokerage on business that is brought to us by a reinsurance broker. We have our own expenses as well. We have to account for the price that has been presented to us as a reinsurer and whether or not we're comfortable with that price. We measure the marginal impact of this new reinsurance contract on our existing portfolio. So we want to know how this new piece of business might be correlated with our existing portfolio. And then ultimately we evaluate also other deal dynamics. So for example, these are legal contracts. So there may be terms in those legal contracts that we're not comfortable with or that we are fully accepting of, and we also make decisions based on that. So the important thing here is that catastrophe models inform our underwriting decisions, but they don't define them. So there are still many, many ways that humans must interpret and adjust the modeling output to make an educated business decision.
Now, the next application of CAT models is in the areas of accumulation management. So accumulation management is the process of avoiding concentrating too heavily in one geographic area. And CAT models are used to identify the concentrations in a portfolio and to measure that loss potential. An example of where concentrations could be a problem is with the wildfires that are occurring out in Napa Valley and Los Angeles. Having an insurance company having too many risks in these areas could lead to a significant amount of loss for that insurance company. So they would want to know if they have a concentration of policies in that area. For many carriers set risk accumulation maximums. They monitor how much business they have in areas and limit those writings if they reach a particular target threshold. So a ring analysis is a pretty common practice used in our industry, as shown in the graphic here, to monitor the accumulation. So it's a simple ring that's drawn in GIS that accumulates the number of policies within that area, the total insured value, the total premium, and a measure of the loss exposure within that area of concentration. Additionally monitoring the maximum loss or the average event loss is another common practice. So the graphic at the bottom of the screen illustrates the size of loss potential from hurricanes landfalling along the coastline. So if you think of the vertical axis as a representation of the coastline starting from the southernmost tip of Texas, running through the Gulf, Florida, up the mid-Atlantic coastline, and ultimately into the Northeast, and using the CAT models to identify hurricane landfalling events and the associated modeled loss associated with those events, and mapping the average or the maximum loss along that coastline helps to identify areas of concentration in a portfolio and the size of loss if an event were to occur in those locations. So that's another way that insurance carriers will help, will understand that size of loss potential based on the amount of business that they're writing in different regions.
All right, so as a reinsurer, you know, we look at things a little bit differently. We're not looking at such a micro level, you know, individual neighborhoods of risk or accumulations of risk. You know, exposure-based accumulations are an extremely conservative view of risk for a reinsurer. And so I'm just going to put up a very high-level, simple example, which is as a reinsurer, we have contracts in place with different insurance companies, which are listed here, companies A through G. And we have treaty limits in place with each of those insurance companies, again listed here. And then just a description of where that company writes most of their business. So company A is a Florida carrier, most of their risk is in Florida, whereas company D is a nationwide writer. So as a nationwide writer, they have some business in Florida, but business in other states as well. So when we just sort of simply say, this is our exposure accumulation and add it up, it's again, extremely conservative. There's really no information given here on where these limits, you know, what the likelihood that these limits would actually attach in a real event. So there's just, you know, this is really overstating what our potential loss amount could be in any given scenario. And here's a very simple, on the right, deterministic sort of, you know, analysis, which says, now if there was an event in Florida, you know, the first line listed there, what would our exposure be? And what we need to do in order to come up with this is we have to add up anywhere that we have limits in Florida. So I mentioned, you know, we write a couple contracts in Florida, we write a couple nationwide writers who have exposure in Florida. I add up all the limits and I come up with a really big number that, again, just, you know, the reality is that even within these territories, there's diversification. It would be highly unlikely that I would ever pay out all of these treaty limits in a given event. So it's extremely conservative. So what we do is we use catastrophe models as a, you know, to better reflect the actual risk that we have. So we can use the CAT models to produce something called an exceedance probability curve, also called a PML curve. We sort of throw around those terms interchangeably in our industry. And really what that curve does is it assigns probabilities to events, and also really it's supposed to represent the likelihood of a certain loss amount to our portfolio or to an individual contract. So in this case, you know, what I'm saying, let's presume, you know, this might be in millions. I could say, well, you know, I have a 1% chance in any given year of having a loss level of 194 million or larger. So what we do as a reinsurer is we have our base portfolio. So this is all the contracts that we have in place today that we are looking to add business to. So using the models, we can evaluate that individual new contract, how it appears on its own as a standalone contract, but then we can also measure what the impact is, the marginal impact to our base portfolio. So what you can see here is that the marginal impact of adding this contract to the base portfolio is less than the EP curve of the standalone contract. So the marginal effect is really a reflection on how correlated or uncorrelated a contract is with our existing portfolio. So this is, you know, typically what you would want to see is that by adding a new contract, you'd get some diversification benefit of adding that contract to the base portfolio.
So the next area we will discuss is in the design of the risk transfer contract and determining the amount of right coverage for that risk. For primary companies, the CAT models are used to inform the design of the reinsurance program. And in this case, the insurance carrier works really closely with its reinsurance broker to evaluate its loss potential and to design the right reinsurance program to cover that risk as it relates to its overall financials and determining the right amount of coverage. So CAT models are used to inform the total amount of coverage needed through the analysis of the severity of losses in the portfolio, the type of coverage that is needed, so a catastrophe excess of loss type structure, an annual aggregate type of a structure, or proportional type quota share structure, or any combination of these coverages. The CAT models are used to evaluate these coverages. This includes any of the layering or inuring relationships, which means which coverage applies first and second and third, and what's that order of coverage that is to be applied. Additionally, CAT models inform what the price of that coverage should be, and then ultimately that market price or the rate on line for that coverage. So the graphic to the right illustrates a typical reinsurance structure. It's just an example of a reinsurance structure. So it includes a catastrophe excess of loss tower and an annual CAT aggregate tower that corresponds with that catastrophe excess of loss. The table is an illustration of some of the pricing components of the catastrophe excess of loss layers. And you can see in the table, we've got the layer, the percentage placed, the limit retention of the structure. The pure premium is developed from the CAT models. So pure premium is really synonymous with the average annual loss. It's the average annual loss that you would expect for that particular layer of reinsurance coverage. And the standard deviation is that measure of uncertainty or volatility around that expected loss. So these come right from the CAT models and are used to inform that catastrophe loss exposure to that layer if that coverage were in place for that particular carrier. Then it's loaded, and ultimately a final reinsurance cost is developed, the rate on line. And to the far right of the table are the layer entry and exit return periods shown in number of years as a reflection of the frequency of which, how often that layer would respond to catastrophe losses. When would it come in play? How often is that layer exposed to a particular CAT event or series of CAT events that would impact that layer over the term of that particular coverage for the reinsurance contract in place. So this is all from the primary company perspective, working with its broker, designing the right coverage, which is then presented to the reinsurers who may be willing to write that coverage and assume that cession of risk. And Wendy will now speak to the reinsurer perspective once that is presented to the reinsurers.
All right, so let's stick with that same structure that Julie put together as a reinsurance broker. So as a reinsurer, we use CAT models to inform where and how much we want to participate on this program. So we look at some key metrics about this program to say, you know, again, how is this portfolio or contract correlated with our existing portfolio? So do we get a diversification benefit from writing this piece of business? How much capital do we need to hold to cover this risk? And is the price adequate to cover CAT and our other price components that we went through earlier? So is there enough price built into the program that will let us allow us to load for our own expenses, the brokerage that we have to pay, the profit that we want to make, and also get an adequate return? So again, just kind of the red arrows are representing we may choose as a reinsurer to not participate anywhere in this program, or we may pick and choose where we want to participate. So in this case, we might want to participate more on the higher layer, less on the middle layer, and a little bit more on the lower layer. And this is not arbitrary. We're using the catastrophe models to say, we think that the combination of all of these key metrics together make one layer or another more appealing, or it melds with our portfolio in a beneficial way. So there's a lot of things happening in the background here to inform this, and using the catastrophe models is a key contributor to that. So in any particular insurance company program, they may be impacted by different events at the top of this program than they are at the bottom of the program. So that just using a very simple example is that this company might have exposures that are driven at the bottom of the program by more frequent events, like let's say by tornadoes or hailstorms. And the top of the program might be more driven by, let's say, a hurricane, a rare hurricane or a rare earthquake that is going to cause a much larger loss but happen more infrequently. So again, as a reinsurer, we have an existing portfolio, and depending on what our existing portfolio is, those things will either meld nicely with our portfolio and give us a diversification benefit, or they will not. And that really is what informs us as to where we participate. It's, the right answer is to never make broad brush strokes to say we will never participate high on a layer, we'll never participate low on a layer. It really is about the calculations going on behind the scenes in the models that help determine where we're going to participate in a program.
So next we will talk about how CAT models are used to determine where to grow a portfolio and maximize the profit in the portfolio while balancing that against the loss potential in the portfolio. And this is a process that we refer to as optimizing the overall portfolio. Now, carriers generally aim for the right balance of risk against profit potential when writing a risk. So identifying areas where there's potential low PML, low loss exposure, but potentially high profit in the portfolio. So these would be illustrated by the green areas in the graphic and in the map shown on the slide. And generally, the insurance carrier is going to want to limit the writings that they have in areas where there's high loss potential or high PML potential and low profitability. And so these would be illustrated by the areas in the red in the map. And so the CAT models are used to inform that balance of risk versus profit. And it provides that description of the geographic areas that have that really high loss potential. And when considering that relative to the price that's being charged or even what the market will bear, then the insurance carrier makes a decision about where it wants to write more business or where it potentially wants to write less business. So where this comes into play is often in conversations that the insurance carrier is going to have with its agents. So the agents are its representation out on in the ground, in the local communities, talking with potential policyholders. So if there's a geographic territory that the insurance carrier would like to have more business because it's viewed as having a lower loss exposure and more profit potential, they're going to want to work with those agents really closely to make sure that they're doing the right advertising, that they're getting out there and marketing the name of this insurance carrier so there's a familiarity in the area, and people generally would be more comfortable signing on to one of their policies. Additionally, it would help inform areas where they may want to slow down their marketing or even shrink the marketing in areas if it's deemed to be generating too much of a loss potential relative to the premiums that they're able to have by writing that potential business. It also informs the acquisition of new business. So in some cases, insurance carriers would want to buy another insurance company or maybe buy a book of business from another insurance carrier. So on the next slide is an example of output from a potential acquisition analysis, and that's shown in the table here. So this is a standard PML table. We've got the probability of exceedance in the left-hand column, translated to the return time in years. The current column is the current loss potential for this insurance carrier for illustration purposes. The projected column is the projected loss if they were to acquire this insurance carrier or book of business, and what that change would look like for their probability of loss exceedance potential. And in this case, you can see that the 100-year loss potential increases 3.5% from 133.7 million to 138.4 million dollars. So 3.5% increase of loss. The premium that they would acquire from this book of business would increase their premium base by 5.3% from 40 million to 42 million. So just looking at those two metrics alone says that they're going to be bringing in more premium relative to the amount of risk that they would be bringing on with this new book of business. So taking those two as a ratio, which is a common way that companies will measure the overall trade-off of risk to profit, is the ratio of the PML to premium. So the ratio in this case actually decreases 1.8%. So there's an improvement in that metric in the performance of the book of business if they were to acquire that new book of business. And so just looking at that metric on its own would support the idea that it would be a good thing to acquire this book of business. Now, there's a lot of other factors that go into play when looking at bringing on an entirely new book of business. This isn't the only metrics that is used, but is certainly one that is considered pretty strongly when thinking about how much risk would they be bringing on versus the amount of premium income that they would bring on and the amount of potential profit in the portfolio. So in that way, then that's how they think about growing their portfolio and continuing to optimize that trade-off of risk versus profit.
Okay, when we talk about from the reinsurer's standpoint, this slide is very similar to what Julie showed a couple slides ago. The blue words are actually just unchanged, which is, as a reinsurer, we can use catastrophe models to help inform, how we build an optimal distribution of a book of business. Obviously, we want to aim to balance risk and profit. As a reinsurer, when we look at the words in black here, this is what's sort of different or unique, which is by definition, we're always sort of writing high risk business. We can't really escape it when we're writing these catastrophe contracts. The key in writing a catastrophe contract as a reinsurer is to make sure that we're getting paid an adequate price for it, and that it's, again, creating a diversified portfolio for us. So correlation is really a critical measure for a reinsurer. Also, we can use catastrophe models. They help, create a roadmap for our reinsurance portfolio managers. So we have people whose focus is to build out the portfolio, grow the portfolio, and using catastrophe models to do that and make good decisions is very critical. So just as a very, simple example, let's say there are two insurance companies that write in very different geographic regions where the risk is uncorrelated. So in this case, there could be an insurance company that is writing only in California, and so they're exposed to, let's say, California earthquake. And then we have an insurance company in Florida, so primarily they're exposed to hurricane risk. When we talk about writing reinsurance contracts for these companies, they are completely diversified and uncorrelated, really. But, we can't just focus on business that is completely uncorrelated. We're going to run out very quickly of the list of companies that we could be targeting, that we could write business for. There aren't that many that really are completely isolated from each other and uncorrelated. And it's important to note that insurance companies themselves are focused on building portfolios in a way to reduce their own correlation of risk. So, an insurance company in Florida is looking for ways to diversify from their hurricane risk, so they might want to start to write more business in California. So it's we have to be able to write business really for any sort of profile of insurance company. We just want to do it in a very smart and educated way. Again, as a reinsurer, we're looking at different insurance companies day in and day out as being a potential client of ours, and there's overlap of risk everywhere. This is a United States example, that we could be looking at a Midwest carrier, a nationwide carrier, a Northeast carrier. And regardless, there is correlation in almost everything that we do. But so if we want to look outside of the US to say, again, how can we as a reinsurer diversify our business? We can look outside of the US. Reinsurance companies are not as highly regulated as insurance companies. So it is very easy, I guess, for a reinsurer to grow in territories quickly and outside of the US. So we may look again to, let's say, Australia or Canada or South America or Europe or Japan or Asia. It's very common for reinsurers to have a global book of business. And again, it's just another way to diversify the book and get away from any sort of single key driver, either key geographic or peril driver. I mentioned sort of geography and peril correlations. My extreme example being California and Florida are really the most important diversification factor. So when we're looking to grow a portfolio of business, we look for other ways to diversify as well. So that could be looking at different types of business. So again, if we are heavily, let's say, personal lines focused, we might want to look to grow other types of business, whether it be, we might want to look even beyond property business and look at work comp. We might want to look at industrial lines of business. We'll look maybe even to diversify by building class. So again, maybe we want to look at single family. Maybe that's a key driver for our portfolio, but maybe we want to look at auto or office buildings or other commercial structures as a diversifier as well. Another thing just worth mentioning is, we want to diversify as well because, we've just touched on this briefly, but these catastrophe models have some inherent risk in using them, and there is a risk of model error always. So, in an extreme example, if all I did was write reinsure mobile home business as an example, and all of the commercially available catastrophe models, had misjudged what the potential risk is to mobile home buildings, and they misjudged that by 150%. And then a real event happens, and now I have been a victim of model error. So we also look to diversify to sort of reduce the risk of model error as well. So just, to summarize, CAT models provide a measure and how these risks complement each other, how they correlate with each other when we're looking at building and growing our risk portfolio.
Now, the last section we will cover is how CAT models are used in response to real events. And in 2017, this is something near and dear to all the CAT modelers across the industry. We had many opportunities to use CAT models during this last hurricane season. So we were very busy using the CAT models when Hurricane Harvey was impacting Texas, Irma was affecting Florida, Maria was in the Gulf of Mexico through the Caribbean, and then even lastly with Hurricane Nate. Now for primary insurance companies, when it comes to dealing with real events, for example, with the 2017 hurricane season, we were running the CAT models to estimate the size of loss potential expected from that event. Now, in prior sessions, it was explained that the CAT models have stochastic events or simulated events within its event catalog, and there's thousands of these events in the catalog. And so one step in our process is to look for events in the catalog that have very similar characteristics to the event that is unfolding at the moment. So for Hurricane Irma, for example, we were all looking for events that were landfalling in Florida, generally in the southeast tip, could have been in the southeast tip, on the southwest tip of Florida, that had a track trajectory that would move it up through the peninsula of Florida and may have been the same size as Hurricane Irma. So looking at Category 3, Category 4, Category 5 type of events in the catalog. So we'd select these representative events out of the catalog, and we would look at the amount of loss that's generated from those events on the portfolio that we're looking at. And from that way, then we can gauge what that loss potential would be depending on where Irma was going to make landfall. Additionally, we would have the opportunity to apply those event characteristics within the model and to mimic that track of that hurricane, and in the same way to try to estimate and project what that size of loss would be. Another step we take is to apply frequencies to the subset of representative events and generate a loss exceedance curve, which gives us a better idea of the likelihood of the different size losses from this range of potential events coming out of the catalog. So these are all really important statistics, and we were working, nearly 24/7 when these events are unfolding and really monitoring where the event was going to make landfall and working with our management teams to inform them what the size of loss potential would be. So this information was going to CEOs, to the CFOs of companies to inform them of the size of loss potential for the insurance company. There may have been a communication out to the reinsurer partners of this company who would be writing the reinsurance treaties that Wendy has been referring to, so making sure that they are informed that they may be needing their reinsurance contracts to respond and pay out and help assist in paying out some of the claims. The information may have gone to boards of directors of the insurance companies. It may have been used to inform some of the public statements that are made out to shareholders for publicly traded companies. And certainly various regulatory agencies were asking for information from insurance carriers writing in these states as to what the projected loss would be as they monitor the overall solvency of insurance companies and their ability to be able to pay out the claims from all the properties that would be potentially damaged from these events. Now, another way that CAT models are used during a real event for primary companies is to inform the number of policies that are potentially exposed to the event and where those policies are going to be impacted by the event. And this is useful in informing a strategy for how to respond to the claims of damage from policyholders. So after the event has happened and people are able to get back into their homes and be able to determine the amount of damage to the property, they're going to call their insurance agent and get on the phone with their insurance company to say, we've had damage and I need to alert you to that, and so that they can file a claim with the insurance company. So the insurance company then is mapping the locations of all the properties that they're insuring, and this is illustrated in the graphic here by the pinpoints, and mapping it against the hurricane force winds that is shown in the graphic here. And this gets an idea of where those strongest hurricane force winds from the event are occurring compared to where the policyholders are potentially located. This helps them determine the number of adjusters that they need to make available and where those adjusters should go, in the case of Irma, within the state of Florida to be able to respond to the policyholders on the ground. As well as they have mobile response teams and they get out in their vans and they go out into the communities that have suffered a lot of damage. They'll know where to deploy those vans and be able to be there to help the people that are affected by the potential loss. So in this way, it helps the insurance carrier respond really quickly to their policyholders, get them, if they need to write a check to give them some money to help them repair some of the damage, or if they need to go into a hotel temporarily, things like that, they're able to really respond to their policyholders. But additionally, helping themselves manage the overall cost of responding to the event. So they're sending the right adjusters into the right locations and not spending money in areas where there are few claims, and then it's just increasing the cost of handling that overall event. So from that standpoint, from a primary company, it's used in a couple of ways. understanding the overall size of loss potential, but also then managing the overall response to the event for the policyholders to be there for them to help pay out those claims.
All right, from the reinsurer standpoint, Julie sort of alluded to this a little bit, which is when an event happens, a big event, the first thing that someone who has suffered a claim or damage to their building is they're going to pick up the phone and call their insurance company, and the insurance company will make arrangements to have an adjuster sent out to look at it. And so insurance companies really get immediate feedback, and they can tell very quickly how big an event is going to be, because they'll start to get calls by the hundreds, by the thousands potentially, and they'll know very quickly. As a reinsurer, we don't have that same type of immediate feedback. We really need to kind of wait for our client, the insurance company, to sort of accumulate the claims, and they're going to track those claims, start paying on those claims, and the insurance company will start to realize that it's either going to impact a reinsurance program or it's not, and they'll have to make a report to their reinsurance broker and ultimately to the reinsurance company. But again, there's just always a delay in getting information as a reinsurer. So in the interim, catastrophe models really play an important role in helping us estimate losses to each individual reinsurance contract where we believe there is an exposure to a particular event. But it's important to also note that modeled estimates really will never fully represent the total loss that we might have to pay out as a reinsurer. And we've kind of touched on some of these things a little bit earlier in the presentation, which is when we're pricing out a reinsurance contract, we do load for, let's say bad data quality. We'll load for things like things that are not covered by the catastrophe models themselves, like loss adjustment expense. But what we do when a real event happens is we go back and revisit those assumptions on a sort of event by event basis. And let me just give you an example of that, which is, this hurricane season, we had Hurricane Harvey that made landfall at the end of August. And so what happens is insurance companies start sending adjusters to Texas to begin adjusting claims there. Well, not even 2 weeks later, Hurricane Irma made landfall in Florida. And so we had these two events that were very close together. And as a result, we fully expect to see increased loss adjustment expense as compared to if only one of those events had happened sort of in isolation. And there's different reasons for that. Independent adjusters, they'll have contractual obligations that force them to be in one place or another. They're out in the field for a longer period of time, staying in hotels for a longer period of time. That increased the costs. They're in higher demand, so companies will pay more for independent adjusters. There's lots of sort of variables that go into that increased loss adjustment expense. But my point is that as a reinsurer, when we're trying to build out our own loss estimates for an event, we'll take each individual event and also the season as a whole and look at it and make adjustments to those assumptions that we've made to say, in these two events, we actually have to increase our load for loss adjustment expense because of the way that these two events have played out together. So that's a very simple example. But again, it's just something that as a reinsurer, we're going contract by contract and taking a look at each of these individual variables and saying, how will this perform in this particular event to help build out our loss estimate? So again, we start with our base sort of model loss estimate. Julie talked about this earlier, using the models to sort of simulate those real events, replicate those event parameters, but then we have to build in additional information to really get sort of a full, robust loss estimate on a contract by contract basis. And then of course we roll that up for an overall loss estimate. So the key here really is being as complete as we can be and being very transparent in how we build out those loss estimates until we actually get those real claims information from the insurance company that will come in typically several months after a real event has happened. All right then, so I just want to summarize what we've covered today and then go to questions. So we talked at the beginning about the key sort of players in the insurance industry and how they relate to each other. We talked about how CAT models are used in underwriting and risk selection, and how CAT models are used to design, in this case, a reinsurance treaty. We talked about how catastrophe models are used to optimize a portfolio, let's say if you're trying to grow a portfolio, and then how CAT models are used to respond in a real event situation. So I think we've hit on everything we agreed to at the very beginning. So I think then I will turn it over to Brian to help moderate on the Q&A.
Excellent. Yeah, thank you, Julie, Wendy. Fantastic presentation. I'll admit I learned a few things myself, which is always good. So at this time, if you haven't taken the opportunity to use the Q&A feature and submit any questions you might have, please do so at this time. And while we're waiting for any additional questions to come in, we do have 6 already. So I'm going to do my best as the moderator here to break them into sections so we can sort of focus our attention on one area at a time, because the questions were great and they were coming in over the course of the presentation across a variety of the different areas in terms of how catastrophe models are really being leveraged. So we'll first start, so for Wendy and Julie and Sherry, on the underwriting side, the first question we got was for mapping the coastline. You had a nice chart there that showed what the modeled average annual loss was by gate. And Julie, I think this was a slide that you were talking through, and it kind of shows the gates at the bottom that were divided into different regions along the coastline. So Texas, the Gulf states, Florida, southeastern US, mid-Atlantic, and the Northeast. The question was for mapping the coastline, mapping that coastline, are you specifying the track beyond the initial landfall? So in terms of those gates and the losses that are being accounted for, are you just taking into consideration the initial landfall, or are you specifying the track as it's moving beyond that initial landfall?
So that's a great question, and it was in the accumulation management section where we had that graphic. And certainly the hurricanes have the potential to make 2 landfalls. So they may landfall, like with Andrew, they may landfall into the southern tip of Florida and then make a secondary landfall in Louisiana. So for purposes of putting together this graphic, that is definitely something when we're analyzing it that we need to consider. How are we representing those track events that do have technically 2 landfalls? And so, it's really up to the analyst to decide how that they want that to happen. In some cases, the view is taken that the first initial landfall really governs the primary location of how it's represented on the graphic. Sometimes it's a function of which landfall produces the largest loss, and then that will govern where it is sort of placed on that graphic. And in some cases, it may be different for the primary company versus what the industry is experiencing. So you may want to may consider the primary or the secondary landfall as the kind of primary gate location, if you will. But great question. It's not really easy to take a track and assign it a gate and then just assume that that's the only area that's affected by that event. I will also expand on this a little bit and say that the loss amount that's generally plotted in this graphic here is the full loss amount for that event. So wherever the track takes the event, the loss is represented by the exposures, the accumulation of all the exposures subject to the full track of the event. So if it's an event that landfalls in Mississippi and trends northeast inward up through Georgia, and it affects some exposures in the Carolinas, all of the loss and the damage from any of those geographic areas are included in the loss amount shown on the graphic. So in that respect, it's representing all of the regions that are impacted by the event. So great question.
Yep, and I think that's the perfect answer. Really nice job there, Julie. So continuing with the line of thought around underwriting, got two questions along that line. The first is, and again, this might be another one for you, Julie, the concentric circles that you said were a common industry approach for accumulation management. The question was, why use the concentric circle, and why not, for example, another geophysical boundary? The example this individual gave was in California. Why would you want to include desert environments versus like forested, fire-prone areas? Like, I guess, so the question for you, for a primary carrier or for a broker who's consulting with a primary carrier, what are some other ways that accumulation management is done beyond the concentric circle?
Sure. Yeah, another great question. Certainly the concentric circle is not the only way that accumulation management is done. And I think it really started when those of us in the cat modeling field wanted to get beyond the traditional political boundaries of a zip code, recognizing that, yes, you can look at the amount of business written in a zip code, but one zip code can sit next to another zip code that has a lot of concentration in it, and in that general area, if a tornado were to affect both zip codes, you would likely not be determining that you have the accumulation of those two zip codes of exposure. And so the concentric circle is a way to rise above those political boundaries and look at a general territory to say how much is within that circle. Now, expanding on that a little bit further, there's an analysis that's commonly done where these concentric circles are moved through GIS across a portfolio. So almost scanning it like a searchlight, if you will. And so as that concentric circle is moved across the portfolio, it is summarizing the accumulations at each of the points of movement. So there's usually some definition of how far that circle is to be moved, how much overlap across circles. And so that's another way that we attempt to avoid being misled by potential overlap of accumulations if we're focusing in on two very distinct boundaries that tend to be located right next to each other. And so it's just a kind of another simple way to measure that accumulation and making sure we're picking up on all of that potential exposure. I think when you're looking at accumulation management, you also want to think about the context of the potential peril that you're considering or concerned about. So tornadoes, for example, have a very defined track. It's usually generally pretty narrow, although the track can be pretty long. It can run for, a mile, 2 miles. It can jump up and jump down. And so when you want to consider potential exposures to a tornado track, you're going to want to be looking at a broad enough geographic area to encompass the potential exposures that would be subject to a tornado track. And so I think it's always important to consider that peril that you're concerned about as well.
And I just want to add one more thing, Julie, to that is based on the tools you're using, and there are some that are more sophisticated than others, you can actually draw any type of shape. You can draw an odd shape of an area that you're interested in getting an accumulation of. So it doesn't have to be a circle or a rectangle or some specific shape. You can just make the points that you want, and it will give you an accumulation within that area. So you can avoid certain desert areas if you want.
Yeah, that's a great point. With the GIS tools, it's really limitless, the type of shape that you can draw around an area. Good point. Thanks, Sherry.
So this was another question related to, we'll call it, combination of underwriting and portfolio optimization. The two go hand in hand. And this won't be a Julie-only question, I promise. So Wendy, I want to give you an opportunity to answer some of these. So the question was, and I'm going to read it verbatim, and then I'll do my best to maybe summarize it a bit. So the question was, how does the fact that there exists only a limited number of previous hazards in any given region increase the subjectivity and biases in the specification and interpretation of catastrophe models, and by extension, an insurer's portfolio changes in response to unexpectedly severe shock. So I think the way that they're trying to ask this is, we know that the models are built, are inherently, will have biases based on historical experience and the ability for sort of the statistics to regenerate the simulated event set and generate ultimately the hazard that's underlying. And so if the models are being used for underwriting and for portfolio optimization purposes, there could be an unintended bias towards where the models are saying the hazard is and is not. And then if you have an event or something occur where the models weren't picking that information up because maybe historically that had never happened, I guess the question is, how do insurance companies and reinsurers handle that inherent bias? I think I did my best on that one, but I think that was the question.
Yeah, I mean, I'll chime in on that, and then obviously Julie can as well. But we definitely look at different paramodels with a different filter, I guess. If we talk about, let's say, earthquake versus hurricane, there's just a lot more reliable hurricane history. Not perfect, but more information, more data points. We have more confidence, just broad brush stroke here, we have more confidence, let's say, in a hurricane model than earthquake, where there really is so much more uncertainty, both in frequency and severity. And so as a reinsurer, when we're pricing contracts, let's say, that cover earthquake versus hurricane, we will apply risk loads differently. We will price those risks differently. We look at different uncertainty measurements for those perils, et cetera. So we very much look at different perils differently based on the points that you've made there. Something else maybe to just point out as well is, when we talk about, let's say, hurricane models, the models, if you're not familiar with these commercially available models, you may not understand that they're not strictly based on historic activity. They're not just recreating historical events in their event sets. They're actually simulating, tens of thousands of events that really are meant to cover every reasonable, combination that realistically could happen. So, for example, you're going to see in these CAT models many more major hurricanes making landfall in Florida than you would see making landfall in New York, because that is more likely to happen. Not that it's impossible to have happen in New York, but it's more likely to happen in Florida. And so these modeling companies really are generating simulations of models or simulations of events that, again, are really meant to cover every possible realistic event, so that they're really, they're trying to cover the case where there is no historical event to refer back to. So they're really not, just to be clear, they're not based on historical events only, although the historical events inform things like frequency, landfall, landfall by gate, what's the frequency of landfall by gate, that sort of thing. But they're really much more robust than that.
And I'll just add to that by saying that CAT models are a mathematical interpretation of this physical process. And there certainly are limitations to our understanding of how this physical process, say of a hurricane, how it unfolds and how it's going to interact with the built environment. There's only so much that we know today. And with every event, we learn something new. And I think we can look back across the last 30 years, and with every major landfalling hurricane, we've learned something new, and the models have evolved and adapted for that kind of new understanding. And so by way of example, I'll suggest with Hurricane Ike in 2008, which made landfall in Galveston area and produced a significant amount of wind damage in that area. When Ike was traveling north through the state of Texas, it actually converged with a traditional convective storm system that was traversing the mid-latitudes of the United States. And so the convergence of those two systems allowed for really strong winds to continue to propagate through those mid-latitudes and even produce some hurricane force winds in states like Ohio, which were, before Ike, were not included in the CAT models when simulating typical tracks of hurricane events. And so it really opened our understanding about the idea that, hey, this can happen. There should be something in the CAT models that reflect the fact that there could be these very rare but still possible occurrences of really strong winds much farther inland than what a kind of general hurricane track would represent. So in that way, then CAT models were calibrated and tuned to account for that kind of new understanding. And I think as a user of CAT models to understand risk, you always want to be asking yourself, what about the unknown unknowns, if you will, and using tools like accumulation management to make sure that you're getting the right spread of risk in the portfolio, regardless of what other type of event or hazard may be affecting all of the properties in that portfolio. So you first need to seek to get the right spread, and then recognize that we're not going to be able to account for every possible type of event or circumstance of an event just because of our limited understanding of the hazards of these events. And so you always want to look at other tools to measure that uncertainty in the portfolio. So I think it's an evolving process, and it's something that CAT analysts are regularly looking at. What are the events we know about, but what are those kind of unknown unknowns as well?
Great, thank you. So transitioning from portfolio optimization into some more specific PML or EP curve exhibit questions. I guess the first one would be, does using years or return period versus probability confuse people, or vice versa? I guess what is traditional either for a primary carrier or broker versus a reinsurer in terms of how they interpret either the return period as a year value versus the probability?
Well, my opinion on that is I do think there's some sort of legacy lingo here, which is, people, I think, were confused by that in our industry when catastrophe models sort of first came into real frequent use, in this industry. People would say, we'd throw away the 100-year return period, your 100-year loss level is X. And people thought, well, that should only happen once every 100 years, which of course is not accurate. It's really your 1% probability every year of having a certain loss level. So I do think historically there's been some confusion. I think that has definitely lessened over time, and people who are familiar with these models and familiar with the terminology are becoming less confused by that just simply through repetition. I do think in our industry we could be more diligent in using the probabilities versus the return time. But again, it's just sort of this legacy, I think, lingo that just has carried through and will likely not go away anytime soon. That's sort of my point of view. Julie, I don't know if you feel the same.
Well, what you tend to see, in my experience, what you tend to see is that actuaries tend to speak in probabilities in very statistical terms, and underwriters or CEOs tend to speak in years of experience as something that's a little more tangible when they think about risk, and so you tend to see the two groups using the two terms interchangeably, and it's just based on a function of sort of their training and their skill set and how they think about risk.
So thank you. Another good PML question. So again, for those unfamiliar, that's probable maximum loss. And I think this was noted I think Wendy, maybe on one of your slides, or Julie, between the two of you, it was mentioned that, in our industry, we sort of use EP curve, exceedance probability curve, and PML exhibit sort of interchangeably, but they do mean different things in the sense that the probable maximum loss value is what we were showing for those different return periods. And I'll let you guys speak to what that represents. And do you feel that there's a trade-off or what are the trade-offs in terms of focusing on the PML, that value, rather than some other metric, for example, tail value at risk.
You want to
Yes.
take that, Wendy?
Yeah, so I think I'll answer the second question first, which is, I work for an insurance company and a reinsurance company, and we use different metrics for different purposes. So it's, again, it's good to not focus on any single one number. You really want to understand all of the metrics that are available. So we will, as an example, as an AM Best rated company, AM Best asks for certain PML metrics to be reported to them. So that would be a case where, we obviously need to understand, measure, and monitor what our PML measurement risk metrics are. But then for different internal purposes, we will look at TVAR metrics, tail value at risk. Again, just depending on what the purpose is, whether it's long-term planning, whether it's capital management or capital modeling, whether it's risk management, cat aggregate management. I mean, there's lots of different reasons, but we would use different metrics in different instances. I think, Brian, was the first part of that question just what that metric is, or could you repeat that part?
Yeah, no, and I'm trying to be sensitive. The individual asked the question obviously has some experience in the industry, but I know we have a varied audience. So I thought it would be good just to quickly define what is the PML and how does that compare to like TVAR as a metric that we can use from the catastrophe models.
Okay. So, I mean, just quickly, probable maximum loss or an exceedance probability curve is really, the quick way to describe it is if you think of all of the events that make up a catastrophe model, tens of thousands of events, they all have an associated probability. What we do is we sort those events in descending order for the loss that they generate. We create a cumulative probability distribution, a probability curve, and in essence, what it's telling you is what your probability of a certain loss level being achieved for whatever you're looking at, whether it's a portfolio of risks for an insurance company, portfolio of risks for a reinsurance company. You could look at a PML curve for an individual location, an individual policy, but the concepts are all the same. So it's really, indicating, again, if we use the 100-year return period or 1% probability example, it's saying what I have a 1% chance in any given year of achieving a certain loss level, or I have a 99% chance of not achieving that loss level. So, that's, it's a very common metric in our industry. Tail value at risk is really looking and saying, given that at a certain loss level has occurred, what's the sort of loss potential on average of losses above a certain loss level. So it's looking at the tail of the curve, the extreme events, and how extreme depends on where you pick out on the curve. So if we're looking at a 500-year TVAR or a 250 TVAR, we're saying, assuming that a certain loss level has been achieved, what's the average of all of those loss levels out on the tail of the curve? I guess that's it in sort of basic.
Yeah, I think that's important too, and obviously depending on which one you're using will depend, like you said, Wendy, on the situation.
Right.
Catastrophe managers, catastrophe risk managers, depending on what they're using the data for, will use them very differently. That was a good explanation. Julie, did you have anything to add?
Nope. I thought, well said, in that, certainly our industry is oriented around the PML and the EP curve, but traditional EP metric, but the TVAR has its place and it has its value in certain analytics, just like the average annual loss metric has its value and its place for use depending on how you're going to use it. So I think it's up to the CAT modeler to understand the nature of the problem or the business challenge or what the application is, and then use the right metric to help inform that particular application of the CAT modeling output.
Great, and we have 9 minutes remaining, so being sensitive to the amount of time, we have 3 questions. I hope to get at least through 2 of them. So the first question of the final 2, we'll keep in line with PML, and this is in the context of portfolio optimization or marginal impact. One of the values, Julie, I think you touched on this, the PML to premium ratio. So the question is, how would you actually calculate that ratio when, for example, the premium isn't available by location or by peril? And the example the individual gave was for like an E&S company, where the premium is available at the policy level, but a policy may cover multiple perils at different locations all over the U.S. Is that value still used in evaluating a new maybe book of business schedule of values that you're including, or how does that typically get handled? Both Julie on the primary side, or also Wendy on the reinsurance side.
Sure. Yeah, and that's a great question. And I think the situation they're describing comes into play if they want to limit the geography of the book of business. So if it is an E&S carrier, they're writing nationwide, and the problem at hand is to look at Florida only exposed locations and generate the PML to premium. Certainly, if there's a premium for I'm just sort of thinking out loud, you've got an underlying policy, nationwide exposed, but you're only considering the Florida locations, and confining the loss to Florida, you're going to want to find a way to allocate that proportional premium out to the state of Florida alone. However, if you're considering the loss exposure from all of the locations for that nationwide exposed policy, you're going to want to include the full premium amount. So I think there's not an easy answer to that. I think it really depends more on what, again, the nature of the situation is and how the information is supposed to be used. What sort of business decision is trying to be arrived at, which will determine if you even do want to take a proportional amount of the premium, or if you really should be considering the full premium of the policy. So it's a little bit of a complicated question, and so I hope I'm addressing it. But I do think it's a little situational around how the CAT modeling output really is to be used in arriving at a business decision that will inform the which premium element should be used in that denominator of the equation.
Yeah, and I think from our standpoint, as a reinsurer, we're really looking, our concern really is with the CAT modeling output, and that has inherent regionality included in it. So it's easy for us to understand where the CAT models are generating losses from. So is it coming mostly from Florida hurricane? Is it coming mostly from California quake for a particular portfolio? And that is really what we use to measure against the premium for the contract. So we're not, as a reinsurer, using that metric that Julie gave as an example in the same way that an insurance company would use it, which is, we're really focused on saying, where is our loss coming from? And knowing where our loss is being generated from, is the premium adequate to cover that loss? So that metric is not as commonly used from a reinsurer standpoint, but still, from an insurance company standpoint, certainly still a very commonly used metric.
Great, thank you both. So I think, given that, I want to spare up maybe 1 minute at the end for myself to let everyone know, or I guess let everyone know a couple pieces of information. This will be the last question, and it has to do with the use of catastrophe models for real-time event analytics. And the question is quite simple. How early from landfall do you typically start using the catastrophe models for event analytics? And Wendy, we'll start with you on the reinsurance side. I know it's a bit different.
Yeah, I mean, it's a bit of a loaded question. I mean, we certainly have the ability to look at, to utilize the CAT models very early, very far in advance of landfall. I just don't know how useful that is. when you're talking about an event that's several days out from making landfall, yes, we get questions about that. Yes, people sometimes want to look at, loss estimates for events that are several days away from making landfall. What we have just found, though, is that there's so much uncertainty at that point in time that it's not really all that helpful, and sometimes it can have the opposite effect, which is just to kind of get people upset. Hurricane Matthew was an example of this a year ago, where, really sort of looked like it had the potential to, run up the coast and hit many different states and have a very large loss potential, and it ended up not being anything close to that. And so, we just have to be very diligent. I mean, it's not unusual to be looking at events, just depending on how certain their track appears to be at a point in time. It's not unusual to be looking, let's say, 24 hours ahead of landfall. Again, we have the ability to do that, earlier out, 48 hours or whatever. And just depending on the event, we may or may not do some of that analysis. If the event looks very certain, it's a fast-moving event, little room for other weather systems to interact with it, whatever. We might look at it, but again, it's just so uncertain that we don't do much of that prior to sort of, let's say, 24 to 36 hours ahead of landfall.
And I would agree with that. I think Hurricane Irma was a great example of that this year, where, there was so much uncertainty around where Irma was going to landfall, if it was going to be on the southeast side of Florida and run up the East Coast. Was it potentially going to traverse more into the Gulf and then turn into the western side of Florida, which it eventually did. And there was so much uncertainty in that landfall. So I think as a CAT modeler, you're looking at all those scenarios and providing that range of outcomes to the management and others who are interested in that information and need to be informed about it. So it's largely a function of the where the event is the track of the event, the severity, and how much certainty you have in all of that, as to how much confidence you have in any of the modeling output that you're providing.
And the only thing I'd like to add, and I agree with everything both of you just said, but sometimes that you do get bugged earlier than you would like. One of the things as a reinsurer we may do earlier is we're not necessarily interested in trying to estimate what the loss would be, but we might dive in and say which accounts or which of our clients will likely have a chance of a potential loss here. So we at least start to get the troops ready on who they should be talking to and paying attention to.
Yeah, definitely.
Mm-hmm. Yep, good point.
Yeah, great point. Well, excellent. Well, thank you so much again, Julie, Wendy. Appreciate your time. Appreciate you, volunteering for this. Sherry, appreciate your inputs as well and helping facilitate everything. This is, hate to say it, it's the third and final installment of our webinar series for everyone who's been participating from the beginning back in October to today. Really appreciate you making the time to dial in and participate. We always get these questions, so I want to make sure I get this out there. The presentation material, so the slide deck that you saw today, as well as a recording of today's presentation, including the question and answer session, will be available on the ISCM website. That's catmanagers.org. It will also be available on the Penn State, the Weather Risk Alumni Society website, and that URL is psuwxriskalumni.org. And there's a section that says events, past event materials, that you can access all that information. We do need a bit of time to put the recording together and make any edits. So usually give us about a week for that information to become available. And I think between Sherry Zola representing ISCM and myself, we usually try to get information about when those materials will be available through an email blast. So everyone should be made aware of when those are available. Again, thank you so much for your participation. Thank you, Julie, Wendy, Sherry. Appreciate your time and energy. And everyone, enjoy the rest of your day today. Thank you.
Thank you, Brian.
Bye-bye.
Thanks, Brian.